Hey everybody, this is Jose Blasco. We are about to get started. As always, before we start, sound check. A quick message on the chat box would be appreciated, so I know you hear me and I know all is ready to get started. I believe that's the case. But again, make sure that you send me that quick message because it helps a lot to make sure everybody is ready to begin. So, a quick hello on the chat box, everyone. Thank you very much. I will turn on the video stream so I can say hello here from my usual space on the screen. How are you, Mark? How are you, Mario? How are you, Joe? Good to see you, everybody. Welcome to the session today. We are 4 seconds to go, 1 second to go. Time to start. Welcome, everybody. This is Options with Options, January 5, 2022. My name is Jose Blasco, first session of the year 2022. For me, at least, not in our programs and our set of sessions, but when it comes to Options with Options, first one. How are you, Christian? So happy New Year, everybody, and definitely an amazing year in front of us to do lots of good trading, and as always, super exciting to begin the year. Before we start with the session, I would like to highlight the disclaimer, so please read it carefully. It's on the upper left side of the screen. It is important information, as I always say, because it is, so read it completely. I am counting on you to do that. Please do not skip it, read it completely. Thank you so much. And now that this is done, I am also highlighting the agenda for today, which is, as always, we're going to be looking at the market, reviewing the trades that we have, and then from there move into identifying new trades to be executed, new opportunities. Cool. One more reminder, actually two more reminders. We have our website, tradewithufos.com. When you add the ending, in my case, /Jose to the website, so basically what you're doing is you are getting to the question and answer page, which is a question where you can log in, click on the green button and ask questions. Even though before you even do that, it would be wise to search for those questions because you may have the answer already waiting for you because other members of the community post questions from time to time. And this is creating really a very rich database of knowledge, which is pretty powerful. But from that, on the upper part of the screen, this is where you have the traddictiv apps. So if any of you is not subscribed yet to the apps and you want to subscribe to top, for example, you just click on the plus sign and you can just go for whatever subscription that makes sense to you. Another thing I wanted to share before we start very quickly, and I'm sure you have noticed that, which is when you click on the live trading button on our website, isn't it? We have a new calendar type of tool which has additional functionality, more advanced than what we used to have. And I wanted to make everybody aware of that, just in case you are not. First thing is that you can see it shows the local time. In my case, of course, being in Asia, it's maybe a different time than you, if you are in the US, for example. But apart from that, when you click on the session that you want to attend, in this case, today's session, so you're going to end up on a page where, again, you're going to see your New York time, you're going to see your local time, all of this is standard. You're going to see a description of the session, which is more useful. You have a clickable link here that brings you to the right place to watch the session, or if you're using it in the YouTube channel, you can do it there. And then super important here, the fact that you can add the sessions to your Google Calendar or to your iCalendar, or you can export to use on Outlook. So keep that in mind because this is probably something that could help you a lot to not to miss the sessions, to be organized. Maybe once a month, you just look at the calendar, look at the sessions you don't want to miss, and you just add them to your calendar, and then you don't miss them. Okay. And also for sure, good idea if you're excited about the sessions that we do and you want to share with the world out there that you're attending a specific session, you can just click on those social media buttons and just spread the word a little bit, which is obviously appreciated. Cool. So we have that, and therefore we're ready to begin. Ahmed, how are you, my friend? Good to see you. Very nice. So let's begin, and let's begin as always with the analysis of the S&P. So where are we at right now? If you look at the daily time frame of the S&P, it's a pretty tiny candle. Not much is happening today. Just a little gap down, tiny. The market is down by 0.09%. Nothing major. But again, more information for us to analyze, which is first of all the fact that there is no green UFO all the way to 468, where 468 it's more or less here on the chart. Okay, so there is space for the market to fall until the next UFO. Okay, this would not be a surprise to me if that was to happen. Why? Because we are in an up climate which has been running for 10 days. One standard deviation, a normal case, is 5 days. It's been 10 days, so this is quite extended. Of course, since we have the beginning of the new year, it's quite normal that there is a lot of price behavior which is totally unexpected, and therefore may not fit in any statistical pattern, because it is a very special event when the year begins, and therefore that may end up lasting 20 candles, or it may turn around very heavily today. Okay, so we'll see what happens. But if we were to rely on stats, which is the best way to be objective, so we have been in this climate for 10 days out of 5. That would be the normal thing. If you recall, in the last session, I also pointed at the fact that when the climate extended on that day, okay, we reached the level of 146, where 2 standard deviations of max distance is 0.74. So in other words, the climate has been lasting for too long, and when it started propagating, it went too far too fast. But all of this points at the fact that the market should, or is more likely going to retrace and give us a down climate, not a major issue. It's just like a couple of days going down, and from there, get back into a healthy type of market behavior and back up. That would be the expectation, okay? Especially given the fact that very clearly today, as an average, the call implied volatility is way greater than the put implied volatility. So definitely from behind the scenes, there is plenty of bullishness, but while there is plenty of bullishness, there may also be a lot of profit taking or whatever, and therefore we may see a climate of 2 days going down. Okay, so careful in the sense that even though the climate is up, we are beginning the year, so just keep in mind that all of those informations, the only one which is more positive really is the implied volatility of the calls above the implied volatility of the puts, but everything else, it's pointing at the fact that we should have some sort of a correction for the market to, again, get to that healthy stage before pushing again to the upside. So therefore, with that in mind, my initial plan for the day today will not be to look for longs. Okay, why? Well, because when you look at, let me bring my mouse in the right place. So when you look at the current duration of the climate being double what the 1 standard deviation is, so I mean, it's not like it's 6 out of 5, it's 10 out of 5, is double, is what in the matrix, right? So if we are scanning using the matrix, is what we here call late. So it's beyond hopeful. Hopeful is anywhere between 6 to whatever, so that's hopeful. But late is when you get into double the 1 standard deviation or beyond. So we are late. Getting long now is too late. So whatever longs you have in your account, that's what you already have. And given the fact that in my case, when you look at my deltas, all my deltas are positive. So my priority today will be to look at putting together trades that benefit from market falling. Okay, so I'm going to be looking for bearish opportunities today as a hedge for what I have in the portfolio, and only after I would enter some shorts, then I'd be open to enter other trades. Ideally, since I got longs and then I'm going to find a short, so then ideally I would enter non-directional trades, and will try, but I need to warn you that probably iron condors and trades of that sort, they may be difficult to find, because the implied volatility of the VIX, which for whatever reason is not loading quickly, here we go, it's trading at 17, which is very low. The last time that we were trading at these levels of VIX, it was here like in November. Okay, so it's quite low given the fact that we went all the way to 35, isn't it? So when the volatility is low, then premiums are limited, and when premiums are limited, finding valid iron condors that pass our rules is more difficult. Okay, that's why I said we may or may not. Okay, so that's what we have from a point of view of market analysis. Please let me know if everybody's clear with me. any question, this is the time to ask. And while you are typing, and by the way, if you have no questions, please just confirm that all is good. A quick okay, a quick I'm with you, Jose, a quick something like that, some confirmation that would really help me. Again, online sessions, it has the beauty that we are all at home. It's very comfortable and convenient, but the problem is that I don't see you guys. So please go ahead and interact a bit with me. That is super appreciated. Now, while you're doing that, positions, okay, let's start looking at the positions that we have, and let's try to understand what we can do with those positions, okay? So first thing, we have COF, okay? So with COF, there is not too much to talk about, even though that stock has been moving up, pretty strongly. Here we go. So if I look at COF on a 2-day time frame, which is when we plan the trade, so it's spent a long time in this bottom portion of the screen, okay, a long time, but finally it's like it's breaking out now and trying to go higher, okay? So it doesn't matter to us, to be honest, because when you look at the risk profile of what we currently have in the account, okay, what we have in the account, please do not get confused with so many rows here. I mean, you probably remember the whole story behind the scenes and why we have so many rows here. But basically what we have, more easily understood here, okay, it's a butterfly, okay? So long one call, short two calls, long one call, okay? And remember, when you do a butterfly, the place on the chart where you make the most amount of money is when you reach the strike where you are short options, which is 179.4, okay? So we want to get as close as possible to 179.4, which is, all the way up here. So we are far from that, okay? And therefore, there is not much for us to do on this trade, just to wait. Remember, this trade is a risk-free trade. So worst case, we're gonna make some money. I think it was $50-something, if I'm not mistaken, per contract. Okay, so yeah, worst case, we're gonna make $58 per contract. Okay, but again, if that stock, which is currently trading at 150, was to rally and reach 179 something, so we can make around $500 per contract, which is way more than 58, is 10 times more. So indeed, we'd appreciate that. We got until January 21st for this to happen. I would say it's not likely at all to happen. So we will very likely end up with $58 of profit, and we don't need to do anything for that to happen. We don't need to close the trade. We don't need to do too much, just to wait. Okay, so we'll be waiting, monitoring, and if anything needs to be done, then I will let you know. Mark, I appreciate it. That all okay. Mario, thank you so much for that confirmation as well. Thank you so much, guys. So this is COF. Okay, what else do we have? We have Yelp. Okay, which Yelp is a trade that has not been working too well, but seems to be in the stage of recovery. Okay, so let's take a look. So I'm just loading Yelp. Okay, just moving to the intraday time frame where the trade was initiated from. Okay, so if I zoom out, okay, so this was the time where the trade was initiated right there. And you can see we had this huge major move against us. So now that stock is trying to fight to come back up. Okay, it seems that there is pretty important resistance at this price level, and price keeps going down. Hopefully, price will come back up, go above that resistance level, and prior resistance sometimes become future support. So now, next thing you know, we may be back in business. Okay, as we are getting closer to this. Actually, the risk profile shows that above 38, we're gonna start making some money. Okay, given the conversions that we have done, but I won't review that because we are far, and we reviewed that last time. But again, break-even was around 38. Okay, so we don't even need to go to where the entry was, even if it's a bit lower. Then we're gonna be able to maybe exit the trade for break-even, or maybe do something else to improve the profitability, which we will discuss when that happens. And then we have two more trades, which is LEN and Qualcomm, which are the last two trades that we put in place. I believe it was on the last week when the year ended. Christian, there is a huge red UFO on the weekly. Yeah, I understand that. I understand that totally. I mean, when you have huge moves like that on an intraday time frame, you may see the effect of that on a larger time frame. Okay. yeah, an Elliott wave would indicate the opposite. Okay, yes, I get you. Uh, how do we reconcile? Well, there are multiple parameters that were present when we entered this trade, such as the stock belongs to a strong industry, isn't it? Even though the stock has been very weak in that strong industry. So that stock belongs to a strong group. So basically, what we've done throughout the life of the trade is use the fact that options give you options. So we use that fact to tweak the trade, to limit the risk, give the trade a second chance, and now we are depending on new on-field orders kicking in and that industry to push that stock. We are depending on that, which depends very much as well on the S&P resuming the move to the upside, which may take 2-3 more days. Again, with Yelp, we are using February expiration, so we have time for this to happen, and I will not be surprised at all that this trade end up, as a small profit or break even or something a bit better. Okay, I will not be surprised. At the same time, what I don't want to do during the middle of a trade, okay, during the life of a trade, what I don't want to do is to kind of like retrade it, meaning that now you have an Elliott wave turning point pointing down. Now you have a red UFO on the weekly time frame. Should I reverse it? Should I reverse this to be negative delta and maybe make money on the way down? Well, in one hand, this makes sense. In the other hand, it doesn't, because the stock belongs to a group which is strong. So we're not going to touch it. Okay, we're not going to touch it. We're going to leave it like that unless you have a different rule in your trading plan. And we are just going to work the magic of options from the point of view of options helping to move from all is good to damage control mode. Okay, that's the wave is pointing out and the weekly time is pointing out. Yeah. So again, that's not really a conflict, I would say, even though I get your point. Okay, I get your point. What and the reason why is not is because in an up climate, okay, sell on-field orders tend to get canceled. So while on the weekly time frame, we may see a red UFO there, okay, right there. Okay, while in the weekly time we will see a red UFO, and here's your Elliott wave turning point, which is the contradiction of the conflict, right? So it's not really a conflict because, being in an up climate, so you would actually not care too much about this UFO because it is likely going to create bounces up and down, but nothing that significant as the climate progresses, because those orders will be either filled and because many will be canceled, being an up climate. So then this market, will normally travel throughout that UFO. If that was not the case, basically the way we would trade is that anywhere you have a UFO, you'd take a trade because you would always expect a bounce out of the UFO. And that's not what we do. What we do is that we overlay on top of the UFOs other market conditions, such as the climate, the grouping, etc., and that's it. Okay, so for us to have a trade that makes sense, and during the life of the trade, we don't need everything to be in line, because there will always be different schools of thoughts or techniques of market analysis that will give you conflicting signals. And even if you were to use only one technique, let's say you only use UFOs, but then you start changing time frame, changing time frame, changing time frames, I'm telling you, there will be a point where you get contradictory information. Okay, but again, what was the original thought behind this trade remains. This is why when we do our matrix analysis and we are looking at the stock filters, okay, notice that the selection I have here is strong up for the long trend strength. I don't do it for the midterm, which would not be wrong. But if you are using stocks from a grouping which are strong in the midterm only, and the market goes against you for a long amount of time, so then what that may mean is that the whole grouping actually became weak too. So now the stock didn't behave, and it doesn't belong to a group which is in your favor any longer. So what I'm doing is to try to mitigate that problem is I'm looking at long trend strength to be strong up. So I know that Yelp, while it's not behaved well in our favor, belongs to a strong group, and therefore when that kicks in, we've seen before what happens when that kicks in, isn't it? Actually, we can see it on the next trade. Actually, which I believe is Qualcomm. I believe that was. Yeah, look at the move. Okay, huge move on Qualcomm in our favor today. So those moves that happen so strong in our favor, typically, of course, not always, nothing is an absolute in trading, but typically those moves happen because you have the power of the grouping and the industry behind the stock itself. It's not the stock only, it's that something else is happening in industry, and there is this cascade effect, this contagious effect of of stocks leading other stocks to move. So we have that in our favor with Yelp, and I would not be surprised to see one of those major moves like that at some point. Okay? We don't know when that's going to happen, and that's why I'm giving myself more time with looking for stocks using the matrix where the selection is long trend instead of medium trend. Okay. Anyway, very good question, Christian, and very good point to discuss. Yes, of course, and again, your comments, Christian, are not only good but also a good opportunity for me to explain the reasons why we do certain things the way we do. While there is no perfection, and there are certainly different ways to do things that all make sense, at least you get to fully understand the rationale of the things that we do in the room. So you could decide if you want to embrace it or not, make it part of your plan, or tweak it or change it or whatever it is. But you understand the rationale, which allows you to do that. And also, if you happen to use it with a bit more confidence than simply using it just because I do, but you don't know why, right? So I really love to explain the why, because it's hand in hand with building up confidence, which we indeed need as traders. Okay, you cannot be a good trader if you are not confident on what you do. Cool. So let's continue. So Qualcomm, I'm going to go back to Qualcomm in a minute because I wanted to check Lennar Corporation first, LEN. So that particular stock has also been moving in our favor. Again, the effect of a stock that belongs to a strong group. You can see how it's pushing hard to the upside. Now, that stock, since we entered the trade on that day, there was a moment in time where that stock didn't behave in our favor at all, but now it's kind of like coming back. So when we look at the performance of Lennar Corporation, if I stretch this a bit more, and I was to look at the midpoint, so we seem to be around negative $35. Remember, we are using a directional bull put spread, so because the stock went against us, so it's not good. Okay, but as long as the stock just pushes a bit more, we're gonna be in profit very, very, very soon. Okay, so I'm not too concerned at this moment in time because we seem to be changing climate from red to blue. The climate was supposed to be 4 to the downside, but it's looking like we're gonna close above the average, and therefore tomorrow will be a blue climate. And also, when you look at price action, notice that those two red dots are thin. So I'm not too concerned. My major concern is coming from the fact that the put implied volatility is greater than the call. But this, if you look at it, this started right there, okay, which was when the move happened, which may be the effect of people getting scared when this strong move to the downside took place. So I'm gonna give this stock, a little bit more time and trust. If that stock closes above the average today, tomorrow I'm likely going to see a blue dot. I'm gonna be in an up climate, and then I'm just gonna go with the flow and let that stock to continue moving to the upside. Ideally, going to reach our target around 121.5 or something like that. Okay. If the stock was to continue going down, so then we're gonna have to move to damage control mode, okay, and we'll need to talk about what to do in cases like that, okay, but I'm not gonna do it today since we are not in that position. And then going back to Qualcomm, which that one has been moving in our favor, okay, so if you think about the day when we entered the trade, that was right here, okay, we entered the trade. I'm not sure why this went like that. Here we go. So we entered the trade. Actually, no, it was not like that. We entered the trade on that day. Here we go. So we entered the trade on that day, okay, and we are above the entry point. So this trade is showing some profit, okay, and the profit we can see here is like 32.5, $30, okay. So that is good, but at the same time with that one, I do have a little bit more concern because I can see how the implied volatility of the puts it's now above the implied volatility of the calls, and this is happening at a time where, what would you be concerned about? Anything really. That stock was moving higher, was in an up climate, but next thing you know, the put implied volatility is rising. So the fact that this is happening, the fact that we are reaching an Elliott wave, target area, okay, which our final target is higher than that, but we are kind of entering already that zone. And the fact that the S&P, as we discussed before, is reaching its theoretical, statistical end of the climate. All of this together concerns me about Qualcomm, and I would like to explore with Qualcomm if I can do anything to protect myself a bit better, lock in some profits, and give this trade the opportunity to profit for me, but also lock in some profits in case this was to drop against me all the way. Okay, so let's go ahead and get the risk graph for this trade, because this is a directional bull put spread where we are selling the 190 and we are buying the 185. So the 190 that was in the money is now out of the money. Okay, it's one out of the money. Notice the break-even point for this trade is 187. So 187 and a half. So even if the stock was to drop all the way here, you would still be in profit. So we are in a good position in the sense that we moved from having that put to be in the money to having that put to be out of the money. This is very beneficial as well. The time decay, the theta is now accelerating because of that. So there are many benefits out of that. But at the same time, there is the risk of that implied volatility on the put and the S&P to move in the opposite direction. And then if the stock falls, well, obviously it's pretty obvious. If the stock falls, this is a positive delta position. And on top of that is negative gamma, because it's a credit strategy, which means that as the stock is falling, not only am I going to lose money, but the speed at which I will lose money is accelerated because delta is increasing, given the fact that it's a credit trade and gamma is negative. So I want to explore what can I do to help this trade. And I believe this is the first time that we are going to try to help a profitable bull put spread. I believe that we have done it for bull calls, we have done it for bear puts, but I don't think, or I don't remember, maybe I'm wrong, that we have done it for bull puts. Okay, so what can we do? Okay, what can we do? And in the end, in trading options, you have calls, you have puts, you can buy. Okay, you can buy them, you can sell them. So the combinations that are possible are relatively limited. While it could get very confusing when trading options because so many things could be done. Options give you options. If you really think about it and you narrow down and you kind of break it down, it cannot be that complicated, right? And you have seen that in many cases, the majority of the strategies that we use when we start moving into damage control mode or locking in profit mode or something like that, we end up creating butterflies type of strategies. For example, buy a call, sell two calls in the middle, buy a call below, or if we do with the puts, buy a put, sell two puts below, and buy a put below the whole thing. Or if we do the iron version of it, so you are buying a call, then you are selling a call and selling a put on the same strike, and then you're buying a put below, which all of these, if you recall from one of the last sessions we did, all of these provide a risk profile which is like that, with the benefit of limited risk with those horizontal lines on the right and the left of the triangle. Okay, so this is what we're gonna do. Okay, this, my friends, is what we're gonna do. We're gonna take the bull put spread and we're gonna try to butterfly it. Okay, now what's the difference between since we enter the trade is now and now? The difference is that since we enter the trade and now, the stock went higher. And what happens when the stock goes higher? Well, when the stock goes higher, the puts become cheaper and the calls become more expensive, right? So in other words, I could certainly find a benefit on combining calls with the puts and do an iron butterfly. But I can also explore what if I do a put butterfly too. I cannot do a call butterfly because to do a call butterfly, I will need to close the puts to then enter everything with calls. But I could certainly either enter puts or enter calls combined with the puts. to do either a put butterfly or an iron butterfly. Which one is going to be better depends on each cases, and it has a lot to do with potential price anomalies. Okay, in this case, we're using February 18. Okay, so if I look at both calls and puts, and let's say I'm going to add, a bunch of strikes. So you can see that not everything is priced the same way. Like, for example, that strike presents a price anomaly there. The 175 strike seems to be the call, seems to be very, very cheap. Okay. So again, there are certain cases that may be more beneficial than others, depending on different strikes. And therefore, you never know when you do this, if the combination with the calls or the combination with the puts is going to be the best. Therefore, the best way to do it is really to go ahead and use the compare spread functionality and copy the primary and copy the primary. So I got two times the primary. And now with one of the primaries, I'm going to convert the primary into a put butterfly. And then I'm going to convert the second primary into an iron butterfly, which iron means you combine calls and puts. Okay. And then the risk profile will tell us what's best. If anything is good, because the other outcome when we do this type of tweaks is that it's not worth it to do anything. So in cases like that, you either leave it alone or you may decide to close the trade. Okay, which that could also be the case if you don't see any benefit and you see a risk. Okay. So anyway, so let's edit the spread. We're gonna start with a butterfly. To do the butterfly, I'm gonna have to add 2 more puts. Okay, so I'm adding 2 legs, both with a midpoint. They are both puts. Okay, one is gonna be sell, one is gonna be buy. Okay, and which one is the one I'm gonna sell? Well, it's the same I sell, which is the 190. And which one am I gonna buy? Well, the one I'm gonna buy is, $5 higher. Why? Because I had the 195, I had the 185, and I had the 190. Okay, I got the field prices here. So those are the ones I had. So then the one I sell, remember, put butterfly is made of buy a put, sell 2 puts, and buy a put, right? So the unit I sell is gonna be 2. So since I was selling the 190, I'm gonna sell another one of the 190, even though it's gonna be a different price. I'm not gonna get 12.55, okay? I'm gonna get anywhere between 970 and 995. Why? Because the market went up, so the puts went down, okay? So I'm gonna do that, and then, since I'm using 185 and 190, and this is $5 of strike price increment, so then I'm gonna go for 195, which is again $5 higher. So I'm just gonna click OK. And that's going to bring in a new risk graph, and we're going to be able to assess if this is something that we'd like to do or not. First thing we can see is that doing this removes the risk of the trade. So worst case, now you're going to make $5. That's the worst case. Okay. But the issue is that at the current price, okay, or lower, that's when you would make the greatest amount of profit. If the market keeps going, okay, if the market keeps going, actually, the more the market rallies, let's say the market reaches, what was the target again? I forgot. Give me 1 second. The target was 190, let's call it 198. So if we reach 198, which is here, somewhere here, okay, good enough. So if we reach that target at 198, if it doesn't take too much time, you're gonna make less than what you would make with a bull put spread. And if it takes a long time, actually you're gonna make even way, way, way less. The most you would lose is 7.5, so you make 7.5. But obviously this is not desirable because now I just killed the directional play that I was doing. So if this was going to be the outcome, and I'm not comfortable, so I would say exiting the trade is actually better. But anyway, so this is what happens with a put butterfly, which obviously is not too advantageous. I'm not giving up on this yet. We may tweak it further to see if we find more benefits. But I want to move into the iron butterfly, which is the one in the magenta color. I'm going to add a couple of legs. In this case, you're going to be using calls. Remember, we said The iron butterfly is made of using calls combined with the puts. So I'm doing buy, sell, sell, buy. I'm doing 185, 180, and 190, and then 195. So same as before. The only difference is that instead of using puts, I'm using calls. And when I click OK, so let's see what the difference is going to be. It's a bit better, as you can see, because now, worst case, you're going to make 12.5. It's a little better. Instead of 7.5, you're going to make 12.5, worst case. But we have the same story, the same issue, which is if we get to the target, again, we are also going to make, 12.5 if that happens all the way on expiration. So not convenient to do this tweak this way. Okay, so definitely the put is not good. So I'm just going to get rid of it. I would focus on the one combining puts and calls, but doing it like that is not working well. So what else can I do to remain with a little bit of a bias to the upside? But what I could do is actually I could create a directional iron condor instead of creating an iron butterfly. I could create an iron condor, and again, because the put side was entered before, so this would provide me with an opportunity to make some money on the way up. Okay, now I'm not sure if this is gonna result in anything which is beneficial enough to accept, but the way you would do it is move everything up by, in this case, $5. Okay, I don't have too many choices. It's $5 strike price increment. So I would, the call side, as you can see, I would be selling the 195 and the 200. And if I was to do that, let's see what happens. I may add risk, I may not add risk. Let's see what happens. I am adding a little bit of risk, okay? So notice that if the market goes to our target at 198, okay? So if we get to our target to 198, our current strategy is gonna make 99. The iron condor is gonna make 78 only, okay? So we're gonna make less money. But if it goes against us, so the worst case scenario of our iron condor is to actually lose $22, where our bull put spread has $250 of risk, right? Which is the blue line all the way down here instead of the magenta line up here. Okay, so we are indeed reducing the risk and keeping a level of profitability, which I would say is fair. 75 versus 97, you are reducing just a little bit of profitability where the risk is reduced by 10. Okay, so I would say that this combination is not a bad idea. Okay, it's not a bad idea. We just need to make sure that the entry prices are going to be convenient from a liquidity point of view, because 980 to 1015 is doable, but it's not the most liquid option in the world. Okay, or not the most liquid strike, I should say. 770 to 780, that's 10 cents. That's a bit better. 5 cents now, a bit better. But again, we need to be careful. You can see how it's fluctuating, okay? In any case, I would like to also assess what if let me see, what if I was to move to, oh no, I cannot move. I was going to say, what if I move to 200 and 205, but the 205 does not exist, okay? So then, if I was to do 200 to 10, I mean, I'm going to do it so you see it visually, but basically now I'm adding risk, plenty of risk if I do that. Okay? If I do that, I'm adding plenty of risk. You can see here now the maximum risk here is $440. Actually, it's even more, that what I have now, which is 250, okay? So not happy to do so, but definitely converting the trade to use that 195 and 200, and now we have an iron condor that I'm okay with. And the other reason why I'm okay with is because let's say the market was to go back down, because that's my main concern. If the market goes back up, typically implied volatility would drop. This is negative vega. So, again, if this happens quickly, I'm going to make a profit. Okay, so I'm okay with that. But what if the market was to go back down? Well, if the market goes back down, you can lose up to $22, right? But what else can I do? Well, then I can convert the iron condor into an iron butterfly. And that would bring in just a bit more credit that may now make my $22 of negative P&L in case I'm wrong. Actually, now I'm breaking even or maybe a small profit. Okay, so I am looking at this choice as the smartest choice, where I'm gonna be matching the profitability almost the same, while the risk is diminished by 10 times, while I'm giving myself a third chance to tweak this trade one more time if the market was to fall. Okay, so I'm just gonna do it. Okay, but before I do it, I would like to make sure that everybody is with me. So please comment on the chat box, my friends. Do not be shy. If all of this was understood, if you are following the rationale, and all of this makes sense. And while you're doing that, I will load Qualcomm on the platform for execution purposes. Here's Qualcomm, here's February. And we said that we're going to be using the call side, and we're going to sell the 195 and buy the 200. Okay, so sell the 195, buy the 200. This is going to bring in $2 of credit. Sell the 195 and buy the 200, correct? Okay, and I'm going to do that. Sell vertical spread, which is using February 18, selling the 195 and buying the 200. Real-time price for that is 220. TOS shows it as 205. Okay, so I'm gonna try 220 at first to see if I get it. You guys be more precise than me. You always know that when I execute, I just want to get filled, so I can move on and have more trades for you and more management in the future for you guys. But you guys just make sure you get the best prices possible when you execute those trades. Okay, like it a lot. Mario, well understood. Wonderful. Thank you guys. So confirm and send. I'm just gonna send it. Okay, the trade is here. I just got filled at 220. So wonderful. Perfect. So let's go ahead and document what we've just done. We got the trade price 10.25 and 8.05. Okay, 10.25 and 8.05. Let me review 10.25 and 8.05. This is what I got on the call side. Yes, correct. So now that I have this here, I'm just gonna copy the position to the clipboard, back to my positions panel, and under Qualcomm, we're gonna add the conversion we have just done. We are now using a directional iron condor. Okay, and that's the trade we have. Perfect. That's it. The rationale, we are adding more theta, but depending on where you are. Okay, depending on where you are in the chart, because let me show you that. So you're adding more theta because you have more credit. We just sold 220 a moment ago, so we just collected $220 additional credit. So then there is more theta, but the theta is not going to be constant. And notice that if the stock goes higher towards our target, okay, with the bull put you get more theta, but with the iron condor you get less theta. For you to get more theta on the condor, you need to be the closest to the midpoint. Okay, so we are getting more theta, but it depends on where. So the rationale behind this is not really to get more theta. The rationale behind this is to get more premium. So we are now defending ourselves better against this trade. If we had done this trade on the original date, okay, which was, let me show you. So if this trade was done on 12:30, okay. So if I load an option chain with Qualcomm using the date 12:30, and we move to February 18, and we look at the premium for the 185 put and the 190 put. So 185 was trading at 1140, okay, at the end of the day. So 1140, okay. The 190 was trading at 1258. So 1258. The 185 call was trading at 555. 555, and the 200 call was trading at 410. Okay, so if we did the iron condor on the day when we did the trade, net result from a risk and reward point of view would have been that the condor had a risk of $237. Why? Because since the market was lower, you would have got more from the puts, but you would have got less from the calls. As the market went higher, you have lost premium on the put, which is good because you sold them, and you have gained premium on the call, which is good because you are selling them today as a second step. And therefore, instead of a trade where you got $237 of risk, right? So the situation that we have, call, let me input again the values that we have. So the situation that we have today is 1025.805. So in blue is what we have today. Okay, I made a mistake with sell. It needs to be buy. Here we go. So the situation that we have, no, I made another mistake, which is the wrong strike. It needs to be 200, 195 and 200. Okay, now I have it right. So if I click OK in blue color, this is the trade that we just have, which has a maximum risk of $30. Where if you had done the whole thing in the first day, you would have a maximum risk of 237. So the rationale behind this tweak is to remove risk on the trade, as we always do as a technique for trade management, when something happens during the life of the trade that may cause a concern. In this case, the implied volatility of the put is surpassing the implied volatility of the calls, and the S&P is in a climate which is now reaching the late stage, and therefore more likely going to fall instead of rally. So we are concerned about that, and therefore it's time to go ahead and bring in the call side to go from a 237 risk scenario to a $30 risk scenario, knowing that on top of that, you can even tweak this further, converting the iron condor into an iron butterfly. Does this make sense, Joe? Is this helping? Let me know. I'll take a sip of water, guys. Okay, and with all of this done, so now it's time to go ahead. Yeah, my pleasure. My pleasure. My pleasure. Very good questions, guys. I love the questions. These are very powerful conversations. Very happy. So anyway, we got 10 minutes left in the session, so I need to rush a bit here. Ideally, we're going to find a short opportunity based on what I said before. I'm looking for shorts, so I'm going to look for top negative CIV spread. We're going to look for the rotation to be strong down. We're going to look for list of stocks. We're going to look for earnings 30 days or beyond. And then we're going to look for a climate, which in a perfect world, it's going to be confirmed down. It's going to be early and near to the EMA, which is going to be very difficult to find out. And in the weekly time frame, confirmed down and sensible. And and early. Okay, so all of these would be like perfect. Typically, why to do this today instead of any other day? Well, it's because it's the first day we see the implied volatility of the puts in that stage. Okay, you could have done that based on the climate in prior days, Mark. And if you recall the conversation last week, Mark, I was saying we want to enter longs, but we don't enter longs without a short. Okay, we wanted to have hedges for the longs in the portfolio. Right now, my problem is that since we meet from time to time only and it's 1 hour long duration and we talk about so many things, so last week I only had opportunities to enter longs. I never enter shorts, and therefore my portfolio is way too bullish. So I am actively managing that by tweaking Qualcomm immediately and now looking for a short. Okay, but if not, you can do it in a more relaxed fashion. But certainly, as the concern is kicking in, which was already happening last week when the climate reached 5 out of 5, isn't it? So you could have looked for some shorting opportunity using stocks that belong to to weak industries, and probably you would have made some money on the way down, as the S&P had a pretty strong day to the downside the other day, and then you could have tweaked this trade the same way we do to the upside, but do it to the downside. Okay. Today, the additional thing is the fact that the stock has the implied volatility of the puts above. Okay. Yes, correct, Mark. Correct. Good question. Very good questions. So again, I'm gonna scan. Probably get nothing if I scan like that, of course. So now the climate being early is very exaggerated. Here, early is very exaggerated as well. So let's start with no near of the EMA. The EMA, still nothing. What if it's sensible instead of hopeful? Probably nothing. What if it's sensible? Okay, and being the S&P in an uptrend, so I'm gonna go ahead and ignore the weekly climate altogether. Okay, and now I am a bit shocked that we don't have any opportunity that meet that rule. Okay, so what if I uncheck this? Now we have a few. Okay, but I don't want to do that because those stocks, they belong to industries that are not necessarily weak. So I'm not comfortable with this, my friends. What if I do no auto climate at all? So we have some symbols, but what does that mean? Well, that's an up climate, okay, but it's a tire climate, 10 out of 8. What about this? This is an up climate, right beginning. This is a climate 2 out of 8, and this is a climate 10 out of 8. Okay, so in other words, it seems that the only way to find a combination that could make sense is to look for climates that are going up, but I want them to be either in late or hopeful stage. So if I look for late, all of these seem to. Oh, wait a minute, I didn't check more of this. I'm like, that cannot be. Okay, so late I got nothing. I got hopeful. Okay, so those trades are not of the highest quality, but remember, we are entering this as a hedge. Okay, so the fact that they are low quality is not that much of a concern because it's a hedge. If I was to enter trades in my portfolio that I need, like let's say I'm looking for longs because the whole thing is to add long deltas, then I would not accept this. I would just come back 1 hour later and check if something's available. Because I'm looking for a hedge, then I'm okay with it, because a hedge, it's not a trade that needs to be of a great quality. It's just a trade that has the greatest odds as possible at that moment in time, that if the market goes against you, so that's gonna pay you. Okay, it's just a protection. So then EOG and Devon Energy are gonna be my picks, and the technique to be used in this case will be an Elliott wave confirmation on the intraday time frame for us to enter. Okay, or the fact that we are breaking any of those pivot lows. So we broke that pivot low a moment ago. There is another pivot low here since we are above the prior pivot low. So I'm just going to use this, right? And here the idea would be to wait for EOG to start moving lower. And the moment it breaks that line, which is in line with that, pivot low, so then you would want to enter into your hedging opportunity. Again, very happy to see that the puts are so far away from the calls. So there is a lot of put buying, there is a lot of bearishness on that stock, even though the stock has been moving crazy high. That stock may now just like correct all the way, and there is a lot of room for this to drop. Okay, so if this stock was to drop, where would we expect it to fall? Okay, that's the question. Okay, and the problem here I have is that when setting a target, the next pivot available is here. And basically, so we are talking about going from 95 all the way to 75. That's a $20 drop, which is fantastic. But my friends, this is what I would like to do, is if I'm looking at the stock like one of the main positions in my portfolio. So unfortunately, I don't happen to have any closer pivot point to set a target on the daily time frame. So I may need to do that using the same intraday time frame that I'm using for the entry. I may end up doing it here because it would be too hopeful of expecting this market to go down all the way, given the fact that the S&P is in an up up movement and so on. And if I do it here, so then my target is really close, which that hedge is not going to protect me too much. Okay, so I'm not very happy to see that. So let me explore if Devon Energy provides a setup that is a bit more beneficial. Okay, well, from an implied volatility of the calls and the puts, they are equal, so that doesn't make me as happy as the prior case. And from a setting target point of view, we have a bit of the same problem with the next pivot is all the way there. Okay, all the way there. So yeah, that one is not an easy hedge, and when that happens, it's a problem. Okay, but it's a hedge, and another way to say hedge is that you need it. Christian, this is funny, my friend. I'm just reading your message there. So I was saying that another way to say hedge is you need it. Okay, that's another way to understand what hedging means. So because you need it, then you need it, because you cannot just be naked with so many positive deltas and now the S&P goes down and now your whole portfolio is in a problematic situation. Okay, I mean, I already reduced my delta by some by converting Qualcomm into an Iron Condor. If you recall, my deltas were like 50, now it's 46, but still, it's I converted a directional trade into a directional Iron Condor, which it's not too directional because it's an Iron Condor, which is normally a non-directional strategy. So you can see how the delta only dropped by four points. So how can I do that? Well, I have to find a solution because it's a hedge. Okay, you need to enter it just in case. Okay, and it seems that it's about to trigger the entry. It just needs to fall just a bit more. So I need to find another way to look for a target. There are many ways on how to look for targets, but what catches my attention when I look at these charts, both on the daily or the 8-minute time frame, is the fact that there is a pretty relevant open gap there. Probably from technical analysis that gaps tend to fill, and I would feel that setting a target around 91 something may be reasonable. 91 something is more or less where the average is. That would be a $4 drop on the stock, which is a significant move in price, and I'd be okay with collecting my profits at that price point. Okay, so in that sense, the opening price of this candle is 91.08. So just to keep it simple, we're gonna set a target here at 91, okay, which I'm gonna place right here, somewhere here. Okay, so that red line would represent the target for the trade. We are entering right here. Another question is, as we are setting a target at 91, so what kind of strategy are we going to use to take advantage of this move to the downside, potential move to the downside? Okay, and I'm using the strategy builder to do that, so we can do it quickly. And it seems that a bear put spread would do. If we use a bear put spread, the risk of the trade, the one on top with the greatest performance, 90, buy the 92.5, sell the 90, that one has a maximum risk of $91. So I would say that would do. I'm just looking at other choices. Yeah, definitely that's good. So let's go for it. Okay, we're gonna do this one. So we're gonna graph it. We're gonna do the 92.5 90 strike 268, 298, 365, 385. So a little bit of slippage there, but nothing too major. We should be able to get those $92, something like that. So let's go ahead and put this trade in, and we will call it a day. Okay, so here is Thinkorswim. We're gonna enter a trade on EOG using February expiration 92.5, 90 put. So using February expiration, we are buying the 92.5, we are selling the 90 put. This shows us $97 of debit. Let me bring again this here. So reconfirming. So 92, 92, 92, 92. Yeah, so I have it all right. So I'm going to try to get 92. Let's see if I can get 92. And that's going to be my hedging trade. I'm doing it now just because we are concluding the session and I want to get filled. You know, what you would want to do, okay, what you would want to do is wait for that candle to go below the purple line. Okay, I didn't wait. Okay, I just placed the order. Okay, so that's what you would want to do. Okay. Now, one thing you can do as well is, you know, that the low of the candle is 95.22. So here is something you can do. So you can take your trade, you can project it, and as you project the trade, okay, instead of looking at the P&L of the trade, you can look at the spread value. And what you can do is, we just said the entry would be, the low of this candle is 95.22. Okay, so you can come to your options projection here and move this to 95.22. Of course, you gotta be precise there because it's just tiny move. So 95.22. Okay, so the most precise I managed to be, if I put my mouse there, is 95.13. Okay, I need to make this larger, maximize it, which is fine. You can do that to be more precise. You can move your windows, and if I do this, you know, I can be a bit more precise as well. So just giving you little tips there on how you can be as precise, something like that. So now I am 95.26, right? And when you do that, okay, so you can see how the projected spread value is $94, which in options pricing terms is 0.94. So one thing you can do is the following. Knowing that the expected price, if that stock drops to this line, is going to be 0.94. So what you could do with your trading platform is to place an order, which is 0.94. And then if you need to step away from your computer and you just cannot watch it, because using a conditional order is not a good idea here, because a conditional order will trigger potential slippage, okay, or you may not get filled if you use the midpoint. So this is one way on how to be able to get the trade and not to miss it. Another way to do it would be to cancel and replace. And when you come to the settings, so now, one second, because I got what I need on the other computer screen. Here we go. So then you can go ahead and select a price point, okay, which is 95.22. Okay, so if that stock goes below 95.22, just get into it, okay, at 94. So now you have double confirmation, okay. And another option is to link it to the mark, because the mark is the midpoint between the bid and the ask. So if you do mark, okay, that means that the moment you get to this price point, you're going to send a limit order with the midpoint of the bid and the ask. But this is kind of like the recipe to miss the fill. So I'm not a super fan because you may miss the fill. So if you're gonna do that, maybe you want to say, okay, I'll take up to 5 cents more. Okay, up to 5 cents more, I'll take it, and then potentially you wouldn't miss the fill. Just giving you a few choices there when it comes to the use of, in this case, TOS as a platform, because I know some of you use it, so this may be useful to you. So you know what? What I'm gonna do is I'm just gonna place it like that, and then I may get filled or I may not get filled. So we'll see that next time we meet. Which, by the way, talking about that, we're gonna conclude the session now. Talking about that, next time we meet won't be tomorrow. Okay, tomorrow, if you look at the calendar, we don't have an option session. We normally do, but we don't this time. So the next time that we'll be talking options is going to be on the 8th with Josip. That's going to be on Saturday. We have a sharpening session where we're going to be talking options. I'll be around as well. And then the next one will also be with Josip. Okay, and then I'm going to be back, and we're going to be combining them. We'll go back to normal Wednesday, Thursday. Again, check the calendar, guys, because we are bringing more stuff for you guys, and that will imply also changes of dates or changes of habits that you may have. So make sure that you check, okay, so you don't get confused and you don't miss it. Anyway, everybody, my pleasure as always. Talk to you soon. Keep up the good work, and thanks for joining me today as always. See you on the Saturday session with Josip. Take care, everybody. Bye-bye.